Alibaba is scheduled to report quarterly financial results on February 5th, 2025. That has investors curious and asking if they should buy Alibaba stock before it announces earnings. I'll answer that question in this video. I'll also preview what investors can expect from Alibaba stock going into the quarterly earnings release, the big numbers to look out for, and hidden factors that might not be obvious to most investors. I'll look at Alibaba's valuation, the forward price to earnings, and share with you my discounted cash flow model for Alibaba stock to answer that question I posed earlier, if you should buy the stock before earnings. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the big factors that's fueling Alibaba's growth, and it's not growing by much, but the factor that's fueling its growth is the cloud business. The management team said in its most recent update on November 15th, 2024, that growth in our cloud business accelerated from prior quarters, with revenues from public cloud products growing in double digits and AI-related product revenue delivering triple-digit growth. Its AI segment is absolutely thriving, as is the segments of similar companies in the United States. Alibaba is sometimes called the Amazon of China, and its cloud business, Alibaba's that is growing its AI business faster than Amazon is growing its AI business. But still, the AI trade hit some hiccups yesterday when the announcement from DeepSeek stating that it can deliver comparable results to the best large language models at a fraction of the cost. That's going to have huge implications if it turns out and it gets verified that you can indeed create these large language models at a fraction of the cost. That might be good for some companies that use artificial intelligence, and it might be bad for some companies that are supplying the AI intelligence industry. However, I don't see the direct connection for the negative in the industries that are supplying the AI market. And I talked a little bit about that when I did a video on NVIDIA. And then especially when you're talking about companies like Alibaba that spend money on these AI capabilities, they can now spend less money and develop better capabilities. The cost of AI could be much lower than was initially thought. And then if you make the next connection and say, well, companies were already spending so much money on artificial intelligence when the cost was higher. Imagine how much more they're going to want to spend when the cost is lower. It becomes more affordable and more attractive. So it's going to be really interesting to see how this all develops, and investors will want to pay close attention to Alibaba's AI segment when the company reports quarterly earnings results. Another thing to look out for from Alibaba is the repurchase of stock. Alibaba has been buying back its stock very aggressively, the most aggressively I've seen in any company in publicly traded markets. They've spent tens of billions of dollars buying back their own stock, maybe as aggressive as Apple has been in recent years. So during the most recent quarter, they repurchased $4 billion of shares, achieving earnings accretion to our shareholders through a 2.1% reduction in total shares outstanding since the end of June. You might be thinking, how does this add to earnings per share? Well, earnings per share, as you might imagine, is net income divided by the total number of shares outstanding. So if you keep net income the same, but you reduce the total number of shares outstanding, then the earnings per share figure rises. And so that's how Alibaba has been increasing the earnings per share, by reducing the number of shares outstanding. It's also an indication that the management team feels its shares are undervalued. I've been saying that Alibaba shares are undervalued for a little more than a year now. I believe since January of 2024, I've been talking about Alibaba being undervalued. So in the latest quarter, the company did grow revenue by 5% and income from operations by 5%. It has been struggling to generate growth. This 5% growth has been one of the best quarters of growth for Alibaba in recent years. Investors should look for the company to continue growing revenue and growing income from operations, operating income as well, so that you can get a sense of better balanced growth and not just growth at the expense of profitability. So Alibaba is now trading at a forward price to earnings of 9.247. It's up a little bit from the bottoms, right? I've been talking about. I've had Alibaba stock rated as a buy for over a year now, and the company's earnings forward price to earnings ratio has been relatively cheap for a long time. And it's because the company hasn't demonstrated very good growth. Its operating margins were falling, its cash flow from operations were falling. And so investors were concerned that Alibaba is not going to be able to return to growth again. And so that's why they earned a cheaper valuation. When you're not a growing business, you earn a cheaper valuation. So even when I did my discounted cash flow valuation model for Alibaba stock, I found that it was undervalued. I found its intrinsic value per share to be $153. The current market price is $90. So that's well beyond my margin of safety, and I can comfortably say that Alibaba stock is undervalued. And I've been saying that for over a year again, I'll remind you all. So I've had Alibaba stock rated as a buy for over a year. I updated that recommendation again today when I was doing my research for this video. I rated it as a buy again. But to answer the question, should you buy the stock before earnings or after earnings? Alibaba is one of those stocks where I feel it's cheap enough. You can buy it before earnings. But if you're really risk averse and you want to avoid that risk, you can buy it after earnings, or you can split your purchase in two and do half before earnings or half after earnings. But my feeling, my research shows me that the stock is undervalued enough that you can buy it ahead of earnings and it wouldn't be a imprudent move, in my opinion. It has more risks to the upside than to the downside at these current prices.
Hey everyone, I'm excited to announce that my book, Make Money Buying and Selling Stocks, a 6-step framework for evaluating publicly traded companies, is finally available for sale. Unlock the power of intelligent investing with my 6-step investing framework. It's a proven system designed by a university professor and a chartered financial analyst. Frustrated by the lack of frameworks that met my needs and high standards, I developed this comprehensive guide to help investors at all levels make confident and informed decisions. In this book, you learn how to assess opportunities, manage risk, and build a portfolio that works for you. No investor should dive into the market without a solid strategy, and this step-by-step framework provides you the roadmap you need. Whether you're just starting out or looking to refine your approach, this guide will empower you to take control of your financial future. I've added the link in the description below.